couple of questions for, I see that some of you already purchased the book. Okay, perfect. And what edition is yours, Josh?
I believe the 15th.
Perfect. How about you, Charles?
14.
14. Stephen?
15.
15. Okay. Gayatri?
Right now I have a 12th edition, but I have requested from the library the 15th edition. So from next
15th
year-
edition?
Yeah.
Okay, perfect. 14th, I have it in the car. I'll bring it after break. Difference between 14th and 15th. I'm trying to remember. Either is none or a very subtle ones. But I already identified those, and it's only about the numbering of the problems, meaning that, let's say in chapter 2, we have problem 2-12 on 14th. That'll be, in 15 will be 12-5, you see, or 2-15. So a point is that just deliberately they just change the numbers to make it a new edition. Other than that, the 99.9% of the book is the same. So, but I'll bring those after break. I'll bring those differences because I wrote it someplace. I noted someplace. It's in the car. Okay, so we're in good shape. Perfect. As far as financial calculators or Excel, so let me know what are going to be your preferences. If you rather use financial calculator, let me know, because you're going to purchase the model that I suggested, and I'm going to teach you how to use it in the class, okay? But if you use an Excel, then of course I'm sure that you know how to access the formulas for financial analysis. So, and also I'm going to display the formulas in case you're not familiar with the usage of formulas in Excel. So how many of you planning to have financial calculator? Because this is a great opportunity for you to learn it. Perfect. Excellent. Excellent. Good. And we're going to do a lot of exercise in the class by using our financial calculator, and I'm going to tell you how to use it. Perfect. Okay. Although we know financial calculators are old-timers machines, right? These days, everybody's basically using Excel. But it's a good opportunity for us to learn. That's what I'm getting at. Perfect. Anything else? Charles, make sure that you remind me break time to go and get those from the car, because I forget. All right. Anything else anybody wants to share with me? Okay. Now, today we're going to talk about something that you're very familiar with. This is about ratios, financial statements. Although you already have taken a course on accounting and you're very familiar with the concept, but I'm going to be using these financial statements to do what, to do the financial analysis. Essentially, we're going to use some of those financial statements and create some ratios, create some analysis, and we're going to find out that why world of finance is based on ratios. Now, first of all, answering the question, why we want to have, by the way, I don't know if I mentioned that or not in the first week, I'm using 4 different books, but you don't have to worry about it. Oh, the only book that you're required to have is the one that you already purchased. However, my books that I have in my resource, those are supplement or supplemental material to our textbook. Like what? Like today when I talk about ratios, your book talks about ratios very briefly. It doesn't delve into deeply in it. So I'm using a different book that it basically expresses the ratios in a much simpler way and with more depth. So Best one. But whatever I talk about from different books, you're going to see the PowerPoint of it in your resource. It's already posted for you. But you're not obligated to buy anything. Okay, so why do we analyze financial statements? Because of many reasons, obviously. Because of the internal audit, because of the external audit. Many people internally, they want to know about our financial statements, like our employees, like our managers. We want to find out the health of our financial health of our company, and we do a lot of financial analysis. Sometimes when you would like to pay dividend, or if you want to extend rewards, bonuses to your employees, well, financial statements are going to dictate to you well, what type of bonuses, what type of rewards you would like to extend to your employees. Because if the company is not profitable, therefore you have a limitation on rewarding your people. So also externally, as you know, in any business, your funds are going to be raised, your capital is going to be raised by what? By two things. Let me see if you know, if you're with me on that.
Issuance of common stock?
Okay. Go ahead.
Oh, so, like we were talking about the last time, is when stock's already out on the secondary market, that's not generating more income for the company when it's just already being traded around. But once they issue new stock, usually, when they issue it out, then they'll take in more funds to raise new projects or do what they got to do with the money.
Correct. So there are two sources of raising capital, right? One is what? Through equity. What is equity?
Ownership of an asset?
Yeah, your common stocks, basically. In finance, common stocks are referred to as equity. Either through equity, which in this case, what is the focus? Meaning that your financial statements are prepared for what? To attract investors, basically. You like to have some investors. Who are these people? They are the people who are going to buy your stocks. So they look at all these, especially if you think about many of those mutual fund companies, hedge fund companies, many investment firms who do have a bunch of investors are interested in your stocks. They would like to know that. They would like to take a look at your financial statements. Companies, those firms, would like to take a look at your statements to see if this is something that they want to buy your stocks and put it in the what? Investors' portfolio. So that's their job. If you put performance there, and how in the world they know how well you're doing, performing, well, of course, financial statements is the number one. And all the analysis, financial analysis, are based on those statements, nothing but. Guess what? If I'm the biggest genius in the world walking in a major company, let's say, I don't know, Microsoft, and I say, yeah, I'm going to do some financial analysis for you. Where do I get the information? Where do I get the data? Financial statements. That's the only thing I got. That's simple. So, therefore, financial statements are the main source of all the data that you need to put together in your analysis to come up with what? Your decisions. Whether you're the CFO or financial manager or any other manager within the company, or you're an investor outside of the company. Now, you may say, wait a second, I'm not going to be issuing any stocks. I'm going to borrow money from bank. Guess what? In this case, bankers are going to be interested in your financial statement because they're not going to give you money and say goodbye and see you after 30 years from now. No, they're going to analyze everything that you have, and they're going to decide that what type of money they're going to extend to you, meaning that you're going to find this out. I'm going to talk about it. We're going to spend a week on it. Is that when you have a smaller portion of your capital, total capital, is by debt, by borrowed money, the rates are going to be much, much cheaper for you. Versus let's say this is like 20% of total capital is in form of debt. You're going to get the best rate. Almost everybody is going to willing to loan you as much as you want. However, if the proportion of your debt reaches to like, let's say 75-80% of your total capital, then the bank is going to be easy with you, meaning they're going to charge you 14% interest because you are extremely risky now. Therefore, how bankers find out all about this, there are certain ratios that they use. And those ratios are what? Based on financial statements. So we're going to talk about some of those. You're going to see that how we're going to manipulate all those financial statements to come up with our ratios. And how important ratios are? Well, they're going to be answering a lot of questions. Meaning that, not that they are the solutions, but they are the clues. If you want to know how financial condition of any firm is, then you're going to do the ratio analysis. Now, is that going to be answered? No, there is no question here to be answered, but it's basically going to show you certain clues as to how the company is operating financially. And then you're going to find the reason as to why, let's say, profitability of the company is low, or the liquidity of company is low, or so far, so on. And those are the answers that you need to always have in order to make your decision, solve your problems. Many companies do have liquidity problems, they are not solvent. And because of that, they have issues, meaning that they cannot raise capital, they cannot borrow money, and just because they are not liquid. And what is liquid? Basically, the level of your what? Current assets. Specifically, your cash and cash flow. They are very important. I'm going to repeat this example maybe many times over in the future, but how good is a company, let's suppose car dealership, brand new Mercedes-Benz car dealership. You show up there, the guy says, look, I have 1,000 brand new Mercedes-Benz in my parking lot, and price of each one in average is $50,000. So you got $50 million of asset. Yeah. How many of them have you sold? Well, none of them. You're hoping, Jesus Christ, you're in trouble. How are you going to pay your electricity bill? How are you going to pay your employees? How are you going to eat? You're in trouble. You're going to go bankrupt any of these days. So that's how important liquidity is. Meaning that when we sell when we generate sales from our assets, makes us more liquid. So we're going to talk about some of those. However, financial statements, as you know, you have taken the course. Charles, you can pass that too. How many financial statements we have? The important ones, of course. The ones that we always use.
4.
What are those?
Income statement, balance sheet, statement of stockholders' equity, and statement of cash flows.
Okay, perfect. So here we're going to take a look at 2 of them that are the most important, which is what, of course, your income statement and your balance sheet. So most companies, including the financial institutions who are the creditors, they use only these 2. Many investors also use these 2. Of course, those other ones are not irrelevant, but these are the 2 most important financial statements that people are interested in. Number 1, we have to distinguish. Okay, now let me actually give you a scenario here. The scenario is that I'm a banker or an investor, but let's suppose a banker. And you walk to my office, to my bank, and say, Dan, I need $500 million. Okay. Let's say, let's suppose that you're an established individual. So obviously I'm going to ask for your financial statements. And let's suppose you just present me with your statement of cash flow, income statement and balance sheet and all these. Now look, I'm looking at it. Balance sheet, total asset, 200 million, total liabilities and owner's equity, 200 million, okay. Profit, 600,000, that's net profit. Okay, they don't mean anything to me. If 600,000 is good, well, I don't know. Yeah, I take a look at your total, perhaps sales, and then take cost of goods sold out of it, do my analysis, of course. But I don't need this. I don't need a bunch of numbers here. You're obligated to give me something that is understandable. Like what? Like when I look at your profit, it's not saying 600,000. It says 2.5%. No, it has a meaning. Meaning that your total net profit out of your total sale is only 2.5. No, that still is not very meaningful. Is that good, bad? Well, in that case, I have a better way of telling. Why? Take a look at the average of the industry. Which industry is this? Well, this is transportation. What is the average rate of return on transportation? It's 5%. My God, you're not doing very well. 2.5 is not good. You follow what I'm getting at? This is why we cannot arbitrarily present our financial statement to potential investors or potential creditors like banks and other places, because it has no particular meaning. No, of course not that they are dummies. They're going to say, oh, we don't know. They could do their own analysis, but they don't want to do your work. You do all these and show it to me. Follow me? Therefore, because of that, we have to know what we need to do. How we're going to prepare our financial statements. Now, number one thing that we need to do when you want to give the, what's the sheet to? Sorry. Okay, so what do we need to do here? First of all, we have to common size all of our financial statements. What is the meaning of common sizing? Anybody?
Putting them in terms of the same quantity. So like putting your balance sheet in terms of percentage of assets.
Percentage, exactly. So presenting your financial statement in terms of percentages, not the real amount. Real amount is for you. But if you want to present your financial statement for the sake of attracting investors or borrow money, everything should be in terms of percentage. As Charles said, you take balance sheet and divide all entries by what? By your total asset. So everything would be a percentage of your what? Asset. Okay, so what is your current asset? Oh, it's like 30% of our total asset. What is your, how much is your cash? You're not going to say my cash is $562,000. That doesn't mean anything. You're going to say, oh, my cash is like 8% of my total asset. Oh, okay. Makes sense? So take financial or your balance sheet, divide everything by your total asset, and present everything in terms of what? Percentage. What are you going to be dividing your income statement with?
Sales.
Total sales. So divide everything in your income statement by your total sales. In that case, everything should be what? In terms of total sale. So hey, I have net income of 7%. Yeah, 7% of your total sales has generated 7% net profit or net income. when you do that, you're basically common sizing your financial statement. And no one in the world, folks, is going to take a look at your financial statement unless, no, I shouldn't say nobody. Your internal people are going to take a look at your financial statements in a raw format, meaning that, oh, they're going to see the numbers, they're going to do their analysis, you're going to pay the taxes based on all those stuff. But outside of your company, external people, they would like to know everything in common size and percentages, because otherwise it doesn't have any specific meaning for these people. So, when you enter a bank and you show your financial statement in common size, also common size is referred to as standardized format, you have to say. Then they're going to look at the percentage of everything, going to say, oh, okay, well, this makes sense, this is good, this is bad, or whatnot. For instance, one of the ratios, the number one ratio that the banks normally look at is called TIE, T-I-E, which stands for time, interest, earned. Times interest earned. What is that? That is basically your net operating income, EBIT, E-B-I-T, right? Your EBIT over what? Your expenses on your interest, or your interest expenses. I'm going to write it on the board. I'm going to show it to you in just a second. You don't have to write it. So my point of saying this is that bankers' number one ratio is that say, wait a second, what is this individual's net operating income? How many times the net operating income is capable of the covering what? Charges on interest. You follow? Because you're not worried about anything about that company. You don't care. The only thing that you're interested in what? That is this individual, is this company, is this firm going to be able to what? Pay my interest every year. That's what you care. Now, of course, you care about a lot of things when you do your analysis about the company, but the moment you approve the loan and accepted the terms, then this is the most important ratio. Well, how many times does the company's net operating working capital is capable of?
Is there a standard number of years they go back to look at those ratios to see
I'm sorry, say that one more time.
is there a kind of an industry standard number of years they would go back to look at those ratios for consistency as opposed to just looking back 1 year?
It depends what the financial statement you're looking at. That is normally done about balance sheet, because balance sheet normally year to year in the comparison of the years makes more meaning of it. Income statement also you could do that, but it's not as significant as balance sheet, because income statement of 1 year also tells you a lot of story. It tells you about the condition of the company. However, as if I'm the banker, I want to know what is your EBIT, how many times your EBIT is capable of covering my interest on the loan that you got from me. So guess what? If you could think about it, if it's under 5 times, I'm going to be kind of reluctant to loan you. Why? Because my God, you know, your total operating income has the 2 times capacity or ability to cover my interest expenses. You're in dangerous zone. Why? Because you're not going to cover other expenses in your company, basically. So anything under 5 times, it's not a safe zone, meaning the banks would not extend a loan to you. Guess what? If your time earned interest is 25 times, they love you. Hey, the company has the ability 25 times to cover their interest on the interest expenses. So those are some of the things that we need to be cognizant of when we're doing our ratios. Now, okay. I talked about all those. So again, like I said, many investors, many bankers, many financial institutions, many professionals, let's say all the stock analysts, if you're a publicly traded company, guess what? They're doing a lot of analysis about your financial health. So I talked about common size statements or standardized statements, and this is an example of it, obviously. You see that in our income statement, everything is divided by sales. So sales is 100%. What is our cost of goods? Oh, it's 75% of our total sales. So here you're going to be making the interpretation whether is your cost of goods sold is high or low or is acceptable or not. Based on that, you're going to have your gross profit, obviously, and then you're going to deduct all other expenses, and you're going to see all other expenses are, again, in terms of percentages of your total sale. So your operating expenses is going to be 10.8, and you're going to be having EBIT of 14.2. So operating income here is 14.2. Now again, is that good? Well, we don't know. What industry is this? Boswell Inc. I don't know. We'll find out. What industry they belong to? Okay, let's suppose Boswell is in appliances. Okay, let's take a look at the appliances average or average peer group of that industry. Okay, what is their average rate of return on, let's say, operating income? Oh, it's 12%. Okay, this company is doing well. And then, of course, you take the interest expenses and earning before the taxes and all these things, you're going to come up with a net income of 7.6%. So 7.6% basically is your bottom line. That's your retained earning. Again, is that good? Well, take a look at the average of the market. For instance, in computer industry, that is 12.5. That's the average. So if you're not earning 12.5 in computer industry, you're not doing something well, or you have a lot of things to catch up with. If you're making 4.5% in transportation industry, you're doing very well, because the average is like 4.5, or I guess it's 3.5 in transportation industry. So again, depends on what industry you're in, and you make those comparisons accordingly. Any questions so far on this one? Okay, and this is your common size balance sheet. You see, in common size balance sheet, we're comparing, well, 2 different years. Because like I said, 1 year itself is not as meaningful. So here what we did, we divided all the entries by our total assets. So everything is in terms of total asset. Okay, how much cash we got? Oh, 5.49 or 5.4% of our total asset is cash. Okay, that's meaningful. How about our inventory? 13% of our total sales is in inventory. Okay, so those are all important figures for us. However, again, that's our total asset side, and total liability is also listed here. Your retained earning, your common stock per value or per share, equities, and so forth, so on, all listed here. However, like I said, if you compared 1 year to another year, it becomes even more meaningful. All of a sudden, you're going to find out, hey, your cash has declined, or has declined with 0.8%. Now, what's the reason? You have to do investigation if you don't know it, but most likely you know it. Why? Your inventory has increased from 13% to 19%. Again, why? Meaning that we're not selling as many, or we have overproduction, or we have work in order, or we have these in transportation, traveling to our customers, and many, many different reasons. But that gives you the clue. So hey, my inventory has increased with 6.2%. And so far, so on. All these, again, you make the interpretation as such. Net plant and equipment, minus 5.6, because we didn't purchase as many in 2010 versus 2009. So, basically that is your common size balance sheet. Okay, now, so far so good, right? Any questions? Now, this is also a vehicle for you to show your common size statements, but projected for future. Why? Because future is more important to your investors or your creditors than the present or past. Yeah, past is going to show us how well you performed in the past. That doesn't mean that you're going to be performing like this in the future. You follow what I'm getting at? Many people make that mistake. Take a look at the historical trend of a company and say, oh, this is like as good as gold. But is it going to be like that also for future? That's an important question. We don't know. So what are the things that we need to prepare for our potential investors or potential creditors is to project the future. Because that's they care most about than your past or even present. So how this company is going to look like 1 year from now, 2 years from now. Because that's why I want to give money to this company. Or I would like to invest in this company. That's the main reason. Now, if you're a company, if you're a firm, and you would like to attract investors or secure a loan, you have to present the future financial statement and financial conditions of your company. Well, how do we do that? Well, you have done half of the job when you common size your financial statements the way that we show, the way that we talked about. Then project this for future. Like what? What kind of, are you going to increase your sale? Yeah, it's going to be 20% more than what we said today. Okay, so all your entries are going to be impacted by 20%, right? Your cost of goods sold is going to increase with 20%. Your other expenses are going to be increasing for 20%, and so far, so on. You're going to do it with that balance sheet. Well, our assets are going to be increasing with 20%. Therefore, our inventory is going to be increasing with 20%. However, the only item in these financial statements that would be unaffected by your percentage of increase of your statement is the what? Owner's equity. Mean that it doesn't mean, if you're increasing the sale 20%, doesn't mean that you're going to increase your stocks in the market for 20%. Or giving the rate of return to all your investors 20% more than last year. That's the only thing unimpacted by 20% increase, let's say, in your sales or your asset and all these things. So you're going to basically make it standardized or common sized and then project it for what? Future. And normally 1 year would be sufficient enough. But some companies do 2 years. But again, if you do it for years beyond that, it becomes kind of a guessing game. You don't know what you're going to be doing 3 years from now, how are you sure with this? So if I'm a banker and you come to me and say, hey Dan, I need to borrow money from you, and this is my financial statements in standardized or common sized and also projected for next year. That is called what? That's called?
Pro forma.
Pro forma. Thank you. That's what the meaning of pro forma is. Essentially, what you're telling your investors or creditors is that this is how I'm going to look like a year or 2 years from now. Based on your pro forma, Based on these performer statements, they decide whether they want to invest on you or extend any kind of loans to you or whatever. So that's very important. One thing also you want to bear in mind, since I'm on this topic, when entrepreneurs would like to secure any kind of funding or raise any type of capital, they have to prepare three main documents, three very important documents. One of them is pro forma. Let me see if you know the other two. You should know. Pro forma is one. The other one is what? Hey, who is this guy, this entrepreneur? He wants me to invest in his company. I need to see three documents. Pro forma, which is your future financial statements, is number one. Number two is what? Your business plan. Who are you? What are you making? What are you providing? What type of product? What type of service? To whom you're going to be providing all these? So your business plan, of course, is a comprehensive document about who you are and what you're doing. The third is what? Feasibility study. Feasibility study mostly is about marketing. And what do I mean by that? If I come up with a magical product, let's say I come up with this. I say, hey, you know what? I produce something that is so magical. What is it? Oh, well, half of this mug keeps everything warm. The other half keeps everything very cold. And by the way, I do have that solar panels in here that keeps this by just, solar power, meaning you don't have to do anything as long as there's a light which is going to operate and keep your things warm in one for a number of days and the cold in other segment for a number of days. Oh my God, what a magical product. Have you sold any of them? No. Have you tried to sell of them? Yeah, but nobody's paying any dime for it. Okay, so you want to borrow money from me? Or you want me to invest on you? Nobody's buying this. Yeah, it sounds to be great, but nobody's buying it. So feasibility study basically tells us, hey, how feasible our product is in the market. It doesn't matter what you think about your product or how magical your product you think is. If they're not buying it, you don't have a business. So feasibility study basically is a marketing research that tells you what type of sales you're projecting to have and what is your pricing strategy. Meaning that how much money people are willing to pay for your product. And how many people are willing to do that. And not that precisely you're going to find out number of people, but you're going to do random sampling. That's what the statistics are for. And you're going to project this. You say, hey, we think that we're going to be able to sell this much or this many. So this basically just giving you some ideas as to how performers are important. And again, like I said, in any business, when you embark on any venture, you must have these three documents. And they have to be not only precise, but also realistic. You're not going to do a banker says that, yeah, our sales were 500,000 this year, but we're projecting 5 million next year. How?
Would the feasibility study usually be done by an outside organization?
Both. You could do it yourself if you have the means. If not, there are many companies that would do it for you for a fee. Yes. Okay. Now, using the ratios. why ratios are important and how we're going to be using those. So ratios basically are going to report to you state of your financials. Meaning what? If you have these 5 different questions, you're going to take a look at those corresponding ratios. Number 1, how liquid this firm is. Let's say you are lending the money to this or buying the bonds of this company. You want to know if you're going to get your payment, which is the interest rate they're giving you on bond every year. So for that, liquidity of company could be important. So if you want to find out how liquid the firm is, and will it be able to pay its bills as they become due, then you're going to take a look at what? Liquidity ratios. My example here was that Mercedes-Benz dealership. How good is that dealership? They're going to go out of business any of these days because of only liquidity, not because of lack of asset or because of the profitability, because of none of those, just because they're not liquid. The second question is that how has the firm financed the purchase of its assets? Remember, this is your liabilities. Balance sheet. I don't know if I asked you this question or not, but if I asked this question last week, let me know. Why do you think the balance sheet should be balanced, meaning that your total assets should be equal, your total liability plus your owner's equity? Why?
Because everything you got was either gotten by borrowing or by going out and finding an investor.
So if there's 1 cent discrepancy here, what does it mean? Hey, what did you do there with 1 cent? I don't see it here. You could put it up there. You could put it in your pocket, but write it in there. Hey, this 1 cent is in my pocket. It's okay.
Oh.
You see what I'm getting at? Is that this is not about how you disperse your funds or what you bought or didn't buy, where the money. It's just about accountability. Hey, you said that you have $560,000 worth of asset, and you borrowed $560,001 from the bank. We want to know what happened to that 1 cent. Oh, it's in my pocket. Okay, good, no problem. We know where it is. And that's exactly why balance sheets should be balanced. So here is, if you want to know how we have purchased all of our assets, but what are the sources of money? Like Charles said, hey, you're going to raise the money through debt or equity. Therefore, if you want to know how they have raised this capital and what is the proportion of, let's say, their debt versus total capital, because that's important. Hey, this company has 80% of their asset is by borrowed money. Oh my God, this company is so risky. You need to know that. So with that, you're going to take a look at their capital structure ratios. Okay? Next, how efficient has the firm's management been in utilizing its assets to generate sales? So basically, how efficiently you're utilizing your assets. Meaning that what? How much sales you generating out of your assets. So in order to, that's called efficiency. In order to do that, you're going to take a look at the asset management efficiency ratios. How the company efficiently manages their assets. Number 4, has the firm earned adequate returns on its investments? Meaning that, hey, are we making money here or not? Well, that's your profitability ratios. You're going to take a look at those. And finally, are the firm's managers creating value for shareholders? Meaning that how we look in the market. You might look perfect internally based on your ratios that we identified, those 4 ratios, but if the market is not perceiving you as such, guess what? You're not going to be very successful. So, market value of your ratios also is as important. Means that how other people see you. That's important. That's perhaps more important than your own analysis within your company. Because if the market thinks that you're overvalued, that's a different story than if market thinks that you're undervalued. So, market ratios is going to determine that for you. Okie doke. Any questions so far? All right. So let's take a look at some of these ratios. Liquidity ratios. We talked about it. So number 1 liquidity ratio is called current ratios. That's your current assets over your current liabilities. And when you do that, you're going to come up with a coefficient or number that represents itself in times. Meaning that how many times your current assets are capable of covering your current liabilities. Of course, we know what current assets and current liabilities are, right? What are the current assets? You have taken accounting course. What are the current assets?
Cash and cash equivalents and receivables.
Account receivable and inventory. Your inventory is also what? A current asset, because inventory is basically source of your cash. The moment you sell your product, you're going to have that. You're going to have it as account receivable, and the account receivable becomes what? Cash. So you sell things, people owe you money, that goes to account receivable, and when you collect, it is your cash. So those are all 3 are part of what? Your current asset. What are your current liabilities? All the short-term liabilities are current liabilities. Okay? So when you divide those, you're going to come up with the number that identifies how many times your current assets are capable of covering your current liabilities. And of course, higher the ratio, better shape you are. So basically what this means that firm had $1.63 current asset for $1 of what? Current liabilities. That's what it means basically. Number 2 ratio is called asset test or quick ratio. And this time we're going to take inventory out of our current asset, then divide it by your current liabilities. Why do we want to do that? Why even we bother doing that? I want you to think about some of these stuff.
Inventory is like the least current, or the least, yeah. takes the
Therefore-
longest to turn into cash.
Therefore, this diluted your liquidity. Example of what? Mercedes-Benz. Jesus Christ, everything is inventory there. If you take the inventory out, they're not going to have any liquidity, zero liquidity. You follow? And some companies do have high level of inventories. Now, what's the problem here? The problem is if the company has higher rate of inventory, they're not liquid. Therefore, they're going to have trouble of paying their bills. And perhaps because of that, they're going to be increasing their what? Level of debt. Therefore, they're going to be risky. Okay, so they're more risky today than the other companies. So what? What do you care? Well, I'm the stockholder. Company is more risky than other companies. Therefore, what am I going to do? I'm going to expect higher rate of return. Simple as that. High risk, high return. Hey, you're high risk. You're going to give me 14.5. Market gives you average of 12, but you got to give me 14.5 to keep your stock. Otherwise, I'm going to dump them all. That's what it is. That's why you should know why company is, how liquid company is, how risky company is, what is the level of their debt, and so forth, so on. Because companies with higher level of debt, or what we call financial leverage, they have higher risk, therefore they have to yield higher percentage of return, period. If they don't, you're investing in wrong company. If you guys remember when I was talking briefly about the stocks, I said that calculation of the cash flow generation of the company is, or the stock is one source of identifying whether the stock is good stock or not. Meaning that you project in dividend payout of the stock, capital gain of the stock, and say, hey, this is a great stock and it's going to be great in the future. But your job is not done. Is it high rate of return? Yeah, it's giving me 14.5% versus 12 on market. Well, yeah, did you do also risk assessment on it? No, please do. You're going to see obviously their level of risk is perhaps twice as average of market. Now make your decision. Not necessarily that means that you're not going to buy this stock. That means that you know what type of stocks you're buying if you decide to buy it. So, also inventory is a very costly proposition. Between 20 to 25% of the value of each item is the cost of inventory of it if you don't sell it for an entire year. So in other words, what I'm saying is that if this is priced $10, the value of this $10, if I cannot sell it by end of the year, it's going to cost me $2.50 to just have it. Now this becomes very significant if you think about companies like Walmart. How many items they have? Oh God, there's tens or hundreds of millions of dollars. What's the average value of each item? $10. So we're talking about billions and billions of dollars. Yeah. So if that's the case, then 25% of those billions of dollars still is like $2.5 billion. That's the cost of inventory of the company. Yeah. So you see how important it is. You reduce that to a level, it's going to basically add into your bottom line. Those are direct costs. By the way, speaking of which, what is the inventory cost of Walmart in particular?
$500 billion.
500 billion. Any other suggestion? It's a goose egg, zero. Would you believe it? Yeah, in reality, it should be 500 billion or 50 billion or whatever, but it's zero. Can anybody think as to how they make that happen?
They make the manufacturers cover the cost.
What do you want?
They consign.
Specifically, what do you mean?
Consignment.
Consignment, yeah, but consignment of different type. This is what it is. They go to their manufacturing companies. They say, hey, we're retailer, our name is Walmart. Would you like us to sell your product? Yes, we'd love to.
Of course.
Okay, sure. Okay, great. But this is how we're gonna do it. Steven, I'm gonna buy your toothbrushes, but I'm not gonna buy it. My customers are gonna buy it. So I'm gonna provide you the shelf space in my store, You're gonna keep it there. When the customers buys your toothbrush, you're gonna get your share, I'm gonna get my share. Therefore, all those products are your inventory, it's not mine. How simple that is, right? But how genius it is. Meaning that they don't have inventory because they don't own anything. You own it. And when my customer buys it, give me my share. Well, I had a cousin, by the way, they were dealing with Walmart, and they were in tea business, in import and export and teas and stuff. So Walmart gave him the space. He said, oh, those 5 shelves are yours, put your teas in there. And my cousin said that I thought, yeah, well, then, whenever we sell, well, I'm going to get my share, they're going to get their share. It's my inventory, it's not Walmart inventory. I accepted all this. And I said, you know what? We'll just leave it there. Whenever they sell it, they sell it. But guess what? That's not the case. Walmart's number one condition is if your inventory turnover is less than 2 times, I'm going to kick you out of here and get somebody else. Meaning that you have to empty your shelves twice a year. Meaning that you don't think that you are put there, whatever we said. No. If you can't sell it, you're out. Because they are not going to be just providing you the shelf space forever if somebody with the hope of somebody coming and purchasing that. Walmart is not going to make money like that. Walmart needs to see people are buying this stuff, therefore getting their own percentage. So inventory is a bigger deal. However, bear in mind, not everybody could do that. You know what I'm saying? If I have a small business and I go and tell Charles, this is my term. Charles is going to say, get out of here. What are you talking about? Because I'm not big enough. Walmart is. When you agree with Walmart deal and make that your own inventory rather than Walmart, meaning that you still are ahead. Why? Because in other companies, the level of the sale maybe is 5,000. Walmart deals in millions, meaning that you're going to sell millions of items in there because of the traffic, because of the people coming to that store. So you have better opportunity to make money here. Even dictatorship of Walmart to dictate what they want is acceptable. Whereas some other companies, if they do that to their suppliers, they're going to say, get out of here. We don't want to even deal with you. So that's the what? Power of sheer volume, if you will. That's what does it for you. That's why we call these companies having economies of scale. And economies of scale is a holy grail for all these companies. Charles?
I was just wondering about that example for merchandisers owning the inventory on the shelf. So they're like pushing the inventory costs back on the merchandiser, but what exactly, like what are those costs? Because if it's in Walmart's space, they're not housing it in their warehouse. It's like in Walmart's.
They pay for it. Meaning that what is inventory? Raw material, work in process, right? Transportation and warehousing or retailing. These are all inventories, right?
Yeah.
Suppliers have to pay for all of them.
But it seems like, so that kind of works out maybe a little bit better for the supplier because they're not warehousing, right?
No, they're not. You know, and again,
So is it
they
like a
they
mutual
still
benefit?
are willing to do it because of the profitability of having Walmart in their supply chain, just because the number of the sales are 10 times, 100 times some other places.
Yeah.
Costco has certain creative process as well. Did you guys know that Costco doesn't have any stores? Did you know that?
Yeah.
Why? Because they are selling their product from where? From their warehouse. Stores are center of costs. Many companies cannot make profit because their retailers, their stores are very, very expensive. People, space, buildings, material, all these stuff, insurance. They have none of them. They send them from their warehouse. So that's genius again. And because of that, Costco is offering something that very few companies in the world can afford offering. Does anybody know what that is? What kind of value you got from Costco when you buy the item from Costco? What are you getting?
Bulk.
Wholesale.
Well, bulk is not your advantage. It's there, but your advantage. What's that, Stephen?
I said the same thing, I said bulk.
Okay, yeah, bulk. But what is your advantage? Why are you buying bulk? That's what I'm getting at.
Oh, it's like a lower per average on your cost. Like if it's like per pound or per individual item, your overall per item is lower when you buy 20 toothbrushes at a time, for example.
Absolutely. And again, folks, it's not even the bulk. Anything you buy from Costco, there's impossibility that somebody's going to beat that price. Impossible. Oh, not only that, but also their quality. Nobody can beat their quality either. How that could be possible? We know why Walmart is successful. Because they are cost leadership, everything is cheaper, but they don't have the quality we know. Or there are some other companies, on the other hand, they offer a higher quality product, but they are expensive. That's how the trade-off is. Let me write it on the board. This is the trade-off. When you buy something, you're willing to pay your money to receive a value. So however, value is equal to quality over cost. Meaning that if you want to provide higher value for your customers, either increase the quality of your product or drop the cost of it. Simple as that. That's the trade-off. Many companies belong here, many companies belong there. However, Costco is the most incredible company. They offer both. How can that be possible? They manage it. They know. That's impossible. To fathom the idea that a company can offer both of them to you. And they do. Because of their innovation in prices. One of them is what I said. They don't have the stores. People just jam in there in their warehouse and they're delivering from their own warehouse. Costco is a warehouse, it's not a store. Is that the only reason? No, there are other reasons as well. But this is how you become profitable by what? Process innovation. These are all process innovation. Many companies are successful in the market because of product innovation, of course, like Apple, like General Motors, like General Electric. But also about many successful companies in the market that they don't have product innovation because they are not producing or manufacturing product, but they have what? Process innovation. That's what makes them successful in the market. So that was in parentheses, by the way. Let's move on. So here, okay, when you take, this discussion was about inventory, obviously. So as you can see here, the same company who had current ratios of 1.63, meaning that their asset was capable of covering their liabilities 1.63 times. Now if you take the inventories away, it's 0.63 times, meaning that their total asset is not capable of covering their total liabilities if you take the inventory away. So that again gives you a lot of ideas as to how the company is, what is the financial health of the company. We could do, folks, the ratios you could slice it in many ways. You could do a lot of ratios of different types. Some are important, some are not so important. For instance, average collection period, we're going to talk about that when we talk about working capital policies. You're going to see that if you divide your account receivable by daily credit sale, you're going to have average collection period. What is average collection period? Let me ask you. It is exactly what it says.
Amount of time to
How?
collect.
What's that?
Amount of time to collect a receivable.
Exactly. How long would it take in average for you to collect your money from your customers? Why you have to collect them? Why you're not getting the money at the time of exchange? Because they don't pay you. Nobody buys anything but by cash. They will, okay, send me the bill. And you send the bill and invoice after 30 days is due. Therefore, you want to know whether 30 days is long enough or short enough, or it is acceptable, it's not acceptable, and what kind of money you're going to be in hole when people are not going to pay you for the next 30 or 40 days. Because you know what? You already paid your suppliers to make your product, but you're not collecting your money. You're in trouble. That's called cash conversion cycle. We'll talk about that. But again, ratio to find out how long an average would take for you to collect your money from your customers, that's the ratio. In this case, it's 20.37 days. Is that good? Well, let's take a look at the average on market. Market says 30 days. So you're doing good. You're okay. Account receivable turnover, again, the same concept. How fast are we collecting our money or our account receivable? Again, that is annual credit sale. Again, divided by account receivable, exactly other way around. Now, bear in mind, here, average collection period is your account receivable divided by daily credit sale. However, on the other hand, account receivable turnover is kind of flip-flop here, meaning the non-annual credit sale divided by account receivable. So like I said, you could slice it in many different ways. Here it shows that how many times a year you're collecting your money from your customers. Okay? So if it's 30 days in average, if you're collecting your account receivable turnover would be how many? If your average collection period is 30 days, what would be your account receivable turnover?
12.
Exactly. Every month you're collecting your money. How many times you're collecting your money within a year? 12 times. So this is what it is. Basically, when it says average collection period, that's 30 days. If it's 30 days, your account receivable turnover would be 12 times. So basically, we're calculating the same thing in different perspectives. That's what we're doing. And why it says annual credit sale, it doesn't say just annual sale. What's the importance of credit in there?
Because if it's not a credit, it's not receivable.
Exactly. If you pay, the guy paid you cash, then what are you calculating all these for? You got your money. You see what I'm getting at? You do all these calculations when you have not received your money in form of cash. You sold it in terms of credit. Okay, in this example, account receivable turnover is 70.92 times, meaning that it's less than 30 days, your days in sales. Okay, inventory turnover, okay, also. Inventory turnover is perhaps the most important, most critical one. Why? Because I talked about it, how important the inventory is for the companies and how important inventory turnover is for the company, meaning that how fast you're selling your product, you're emptying your inventory. The ratio for it is that you're going to take cost of goods sold and divide by your inventory. That gives you your inventory turnover. Again, you're going to see later on in this discussion how important that is. For instance, in this example, this company's inventory turnover is 8.63 times per year, meaning that they're emptying their inventory 8.6 times a year. So how many days they have their inventory? Meaning that this is kind of a trick, not tricky, it's not there, but I'm asking you. If your inventory turnover is 8.63, how many days your inventory is sitting in your warehouse or your inventory?
40-ish. Around 40.
What did you do?
364.
Yeah,
You
just-
divide it
Divided by 8.6.
365
Yeah.
by 8.63. Hey, for 42 years, I have my inventory in average all the time. That's how you, again, like I said, same thing, you slice it in different way. Here you go, it's 42.29. You were not far off. So, yeah. Now, this is, again, remember what I said earlier. I said the ratios are not the answer, ratios are the clues. That you basically, by looking at the ratios, you say, hey, I got to do some investigation as to why my inventory turnover is high or better than the others or worse than the others. And then you do your research on that. However, this is a good example of it. The three computer companies, of course, Dell, Apple, HP. So, let's take a look at some of the ratios of these three companies and how they compare to each other and see what we're going to be concluding from that. Okay, their current ratios. Dell, 1.63, Apple 2.04, HP 1.47. The peer average group in the industry is 1.75. So who's doing good, who's not? Meaning that who's better than the average of the market and who's not? Dell is not, HP is not, Apple only exceeds the peer group average, meaning that their current ratios, meaning that their assets cover their liabilities twice. The other ones cover it what? Less than twice. Asset ratios, taking their inventory away. Again, both companies of HP and Dell are not as average of the, they didn't meet the average of the market. However, Apple did. Account receivable turnover, again, this time Dell is doing better, Apple is doing better, HP is not. And finally, the inventory turnover, you see that Dell is doing 47.7 versus the average of the market is 33.87. And Apple is doing 56.45. And guess what? HP is at 11.29. So these are the area of concern for, let's say, HP. HP is basically, in all the ratios, they are below the market. And you see that inventory turnover of Apple, and they are way above not only HP, but also average of the market. So, what do you do here? Let's say you're the executive of HP, financial manager of HP, CFO of HP, and then you're looking at these figures. What are you going to do? What are you going to do in order to improve the inventory turnover of HP? Meaning that obviously they are suffering from a lack of sale here. Then you're going to take a look at the nature of or business plan of these all three companies. You're going to find out easily that the strategy of Dell to sell their computers is quite different from what HP. Why? Because Dell doesn't make any computer unless you order it. That's why. They don't have inventory or big of inventory. On the other hand, HP's strategy is make bunch of different computers, laptops with different bells and whistles and put it in Costco for the hope somebody's going to walk around and buy one of them. That's the total different strategy. So that's how they manage their inventory differently. And that shows in their ratios, inventory turnover ratios. So, those are some of the things that you want to make interpretation of it and conclude or arrive to your own conclusion from those ratios. Okay, next is capital structure ratio. What is capital structure ratio? Basically is determining or identifying the source of your capital. And how we're going to do that? By looking at certain ratios. So the first one, debt ratio. The second one is times interest earned ratio. Basically, your debt ratio is your total liability divided by your total asset. Okay, if I flip-flop this, meaning that I divide total asset by total liability, what is that called? Folks, what I'm saying is that your total liability, if it's divided by your total asset, is called debt ratio. If I flip-flop this, say total asset divided by total liability, what is that going to be called?
Asset ratio.
Current ratio, exactly. We talked about it. So again, the same thing. Yeah, these are again the same thing, got sliced in different way. However, in this particular ratio, it becomes significant because debt ratio is what? The symptom or the identifying factor for your financial leverage. What I mean by that is that some companies have the financial leverage, therefore their rate of return on their investment is what? Is higher than rest of the companies or higher than average of the market. Why? Because they have high level of debt. That's what. When you have higher level of debt, you have financial leverage. Now you want to find out financial leverage of the company, go and take a look at their debt ratio. Okay, in this case, this company's debt ratio is 57.40%. What does that mean? 57% of their total capital is raised by debt. Is that too high? Normally it is, meaning that average of the market is less than 57%. So this company is slightly risky. Okay, another capital structure ratio is times interest earned. I talked about it, remember that? So operating income or EBIT over your interest expenses is your times interest earned. Meaning what? How many times your operating income is capable of covering your interest expenses, that's all. And like I said earlier, this is the most important ratio banks look at. In this case, for this particular company, is 5.38 times. So basically their EBIT or operating income covers their interest expenses 5 times over. That normally is acceptable. But if it's under 5, normally is, like I said, companies or banks are reluctant to lend money. So this is a comparison of the Home Depot versus Lowe's. Ties interest earned. And you're going to see that Lowe's are doing better than Home Depot. When you have 6.69 times your asset or the EBIT is covering your expenses, is much better than 4.94, because like I said, in under the 5, company or financial institutions or banks are not comfortable. Okay. Next, asset management efficiency ratios, meaning that how efficiently we are utilizing our asset to generate what? Sales. So what are the ratios here? Turnover ratios would be 1, total asset turnover. Total asset turnover basically is your sales over your total asset. That's your efficiency. Here we're saying it is, in this example, it is 1.37 times. Meaning that our sales from our asset, we're creating 1.37 times of sales. Is this good? Well, average on market is 1.15, so yeah, you're doing better. So basically what it's like 1.42 or 1.37, what it means is that the firm generates $1.42 in sales per dollar of assets. Means that out of your $1 asset, you're generating $1.42, meaning that 42 cents over $1. That's your total asset turnover. Why that is important? Because higher the number is, more liquid you are, more efficient you are in utilizing your asset. You also could come up with the fixed asset turnover. Again, like I said, in ratios, you could do many things. Any number of the ratios you could create for different purpose. If you want to know what is your fixed asset turnover, again, you take your sales and divide it by, of course, your net plant and equipment. In that case, in this example, is 2.03. Average is 1.75, so you're doing again better than average. Okay, so how this company is performing? This bodes well, I guess. By looking at their ratios, obviously those are turnover ratios only. We're gonna see that their total asset turnover is 1.37, while the peer group in the market is 1.15. So obviously they're doing better than the average of the market. On fixed asset, they are 2.03 and the average on market is 1.75, therefore they're doing good. Receivables, also they're doing good. However, inventory turnover averages 7 times a year. They're turning over only 5.36, meaning that they are under the average of the market. They are not doing as well. Now, when you look at this, what are you going to do? Well, you're going to focus on the inventory of this company and say, why in the world they are not? They are very good in all the categories, but here in inventory turnover, they're suffering. What's wrong with this company? What's going on here? And then you're going to do your investigation, perhaps come up with the idea that, hey, you know what, they are not using just-in-time strategy. Or they carry too much inventory because they are very conservative. Many, many different reasons that you come up with as to why their inventory level is lower than the market. I mean, that turnover is lower than the average of the market. That's the function of ratios. That's what you want to get out of ratios. Just the clues, just the idea that where I need to focus on. Profitability ratios, obviously, is very self-explanatory. How profit you are, what is your rate of return on your investment. Let me ask you one question. If Josh's company, let's say Josh has a company that generates $500 million a year. On the other hand, Charles' company generates only $5,000 a year. Which one are going to be more profitable?
You couldn't, well, wouldn't you want to look at the whole picture? You wouldn't just want to look at these two numbers? You know, I might have a lot more depth than he does, so then that way probably he would be the better guy to go with.
Perfect. So we're not going to say debt, we're going to say cost.
Cost.
Yeah, he's making $500 million, but his cost of doing business is $600 million. He's losing $100 million a year. On the other hand, Charles is $5,000. Well, guess what? Only $2,000 of them is the cost. $3,000 a profit. So he's extremely profitable versus Josh, who is losing money. So level of sales or level of revenues are not indicative of your profitability. That's what I'm getting at. So what is then, if the level of revenue is not, then what is? Cost control, folks. Your profitability has only one key, and that is cost control. That's it. How much we made last year? 5,000. Well, that's not much. How much is the profit? Oh, 3,000 profit. Oh, well, that's good, because we control the cost. Versus $100 million. What was the cost? 99% of the total revenue. Well, that's not very good. So I remember when I was in my company for 20 years, that was one of the biggest emphasis we had in our company. Meaning that when I dealt with my managers, supervisors, all I said is that, hey, your contribution company is not that you are working harder or longer, it's that you want to work smarter. And what is that? Is that think of it as like this is your own house, this is your own business. What are the areas that you want to cut the cost or not spend a lot of money? Think about it. When you think in that manner, then we're going to be profitable, regardless of our level of revenue, level of sales. So don't worry about sales. Worry about cost. Okay, so profitability here, our gross profit margin is our gross profit, obviously divided by our sales. And in this example, this company is gross profit is 26%. Meaning that for a firm spends 74 cents as cost of goods sold and only profits 0.26 or 26 cents out of a dollar. So this doesn't look bad, but when you calculate the operating profit, you see that drops to 14.2. What is operating profit? Is your net operating income or your EBIT divided by sales. In that case, it's 14.2. Now, is this good? Again, remember, compare it to the average of the market. Market is 15.5. No, you're not doing as good. Finally is net profit. Obviously, we know net profit is your net income divided by your sales. And that in that case, in this company, all of a sudden your profitability drops to 8.71 when it comes to the net profit. Remember, that was like 14 for the operating income and 18 for the other one. So you see that your net profit obviously is lower margin when it comes to net profit. In other words, from each dollar, your profit only was 87 cents. Not 87 cents, 0.87. Okay. Operating return on asset ratio is actually is your net operating income divided by your asset. But I'm going to be putting this on the board for you because here it is not very clear, but I'm going to explain that to you a little bit better. Yes, please. Thank you. Okay. Folks, the first question is, how do you determine a company is successful? What are the things that company has to meet those goals to be successful?
Profit?
Profitability, exactly. So profitability is number one. So you have to be profitable, number one. Okay? What else? Is that all? We have to be only profitable? Remember what I said earlier, right? But there are three elements, as actually Josh mentioned at the beginning of the class. You need to have all these three in order to be successful. Profitability is number one. What is number two?
Efficiency?
Yes. You have to also be efficient. What is the third one? Is financial leverage. Okay. What's financial leverage? Companies who do have higher rate of debt, they have higher financial leverage. So are you telling me then that if a company has 90% of all its assets purchased by debt, they have higher financial leverage? Yep. So what does it mean? It means that your higher rate you're going to be in your investors or investment, you're going to have higher rate of return for your investors. Oh, that's wonderful. Not necessarily, because also you have higher what? Level of risk. You follow me? So having financial leverage provides you the opportunity to have higher rate of return on the investments. But also it doesn't mean that it's perfect, this is good. Well, this is risky also. But you need to know that. What is efficiently? How much sales we generate, from assets. What's our profitability? How much profit we're making from our sales, right? So, if I'm saying these are the three elements of success of the company, what would be the bottom line? Meaning that, is there something here that I say, I got all these three, therefore I got whatever that is? Yeah, we could know that. We could find that out. How? By using ratios. Okay, let's do that. What is the profitability ratio? I'm waiting for you to respond. What's the profitability ratio? Right? Your net income from your total sale. Of course, you know that when I'm asking this question, I'm suspecting that you should know the answers. Either I talked about it, or you got the idea from your other course, accounting. So, profitability is your net income over what? Total sales. You should have known, I'm sure that you know that from your accounting class. Okay, what's efficiency? How much sales you generate of your assets, right? Therefore, sales over your total assets. So far so good? How about financial leverage? How much of your assets are financed by owner's equity? Why I'm putting here on owner's equity? Why I'm putting even equity here? because your source of asset is purchased by either stocks or equity or debt. This basically gives you the ratio of your debt. This is also called equity multiplier. Which basically is 1 minus 1 over your debt ratio. Okay? Now, meaning that to what degree you have had debt in your financing. Okay? Then what is this? Can anybody help me to find that? I want to find this out. What is this? And I gave you everything.
Net income divided by owner's equity.
Yes. Sales cancels sales, asset cancels asset. So this bottom line is what? If your net income over owner's equity, or net income over equity. What is that called? That's called return on equity, or ROE. That's the bottom line. What does that mean? Return on equity. What does it mean, folks? I mean, it's self-explanatory, but I want you to kind of participate and be active a little bit. So what does that mean? Return on equity.
How much income you can generate given the amount of equity you've got?
Yes, that's correct, but
Ratio.
this is how you're going to say it.
Yeah.
What is rate of return on your stocks, buddy? That's what it is. What is the rate of return on your stock? So higher that is, better your company is, more successful your company is. And then you ask the question, why? Because it includes all these elements that are the core of your business. It captures your profitability, captures your efficiency, captures your financial leverage. It captures everything. So you cannot have higher rate of return on your stock unless you meet all of them. That's what it means. Are you profitable? Yep. Are you efficient? Yep. Do you have financial leverage? Yep. Your stocks are going to go up. That's it. And if anybody out there that doesn't have this priority, has different priority, they are in wrong business. Okay? Go and open a non-profit firm or organization someplace and have fun. You don't belong here. This model is introduced by DuPont years back, and DuPont Chemical Company that we know. So they basically come up with this the first time. Now this is something that all the companies now using, this DuPont model. Now, let's suppose that your assignment is to figure out the return on equity of UPS. Okay? Let's suppose I gave you this assignment. Hey, to find out return on equity of UPS, not by looking at the market, but calculating it yourself, the true rate of return. Because like I said, the market never is accurate in reflecting the rate of returns. Why not? Why not? Why are we not looking at the market and say, hey, this is it? Why bother?
There's an intrinsic value?
Yes, because market operates based on speculation. Supply and demand determines the value of it. Hey, we don't know why, but Stevens' stocks looks to be good. Let's buy it. Boom. Jesus Christ, it's going up. Is it really good? Not really. It's just people, for whatever asymmetric information they get from their cousins or nephews, they go buy stocks. That's how it is. Only stock analysts do know the value of their stocks. And they are the people who manage what? Your finance, manage your mutual fund companies, manage your portfolios. Those people know what it is. But the rest of the people, which is like 90% of the population, they don't know. They just buy stock based on, I feel good about this. Okay. So, my point is we're not looking at the market, and I said, let's suppose if I give you an assignment, folks, go and figure out the return on equity of UPS or FedEx, whatever. What do you need to do? Oh, by the way, you could easily do this. Where are you going to go?
The shareholders section of the company's website?
Well, that's cheating.
Oh. Oh, okay.
I want you to figure it out, not to go to the website to say, hey, well, I see it here, well, but that's not what I mean.
The financial statement.
And it's like, hey, figure out the price of or value of the stock. Wall Street says 75. That's 75. What's
The
that?
financial statement is to calculate the
Yes.
profit.
What are the financial statements? Where we're going to get this net income from?
From the common income.
Income statement. Where we're going to get the sales from? Income statement. Where we're going to get the assets from?
Balance sheet?
Balance sheet. Where we're going to get the owner's equity from?
Statement?
Balance sheet. So all you need is grab FedEx or UPS's 2 financial statements. Balance sheet, income statement. Boom. You could put that together yourself. And how managers, financial managers and CFO of companies do evaluate other companies. Okay, I want to invest in this company, I'm going to buy some of the stocks. Is it aggressive stocks or conservative stocks? I have to better make a decision on that, because if my portfolio is very risky, I want to buy a conservative stock. How do you know this company's stock is conservative? Well, your answer is not going to be, well, I look at the market. No, don't look at the market. That's always deceiving. Calculate it yourself. Oh, how am I going to calculate this? Boom, right there. And then you come up with the rate of return compared to average on market. Oh my God, this is high. And then you're going to say, why this is higher than average on market? You're going to take a look at this and say, oh my God, they have said they bought their asset, 75% of their asset by dip. That's why they're risky too. That's how you analyze some of these stuff. Do we need to do that? You betcha. You're not going to be running any company. You're not going to be in charge of finance of any place unless you know how to do some of this stuff. And where I get the data? Financial statements. You give the financial statement to financial analyst, they give you 5,000 pages of different analysis of the company. Only with 2 financial statements, and each one could be 1 page. That's what I'm getting at. Okay, so this basically, oh Jesus Christ, let's just put this on. Any questions on this or any comments on this? Okay? Yes, sir.
Where do you actually find the financial statements? Is that located in the company's website under shareholders relations, or is it?
Well, I mean, those are all published. They're all available to you. You go to their site, yeah, I'm sure that's going to be there. if you are the shareholder, you're going to get the financial statements, and especially if they want to collect the proxy. You know what proxy is, right? Do you? How many of you do have 401k with your companies or institutions that you are part of? Any of you? Yes. Okay. So do you get your proxy, right? What is proxy?
Voting rights? Is it voting rights?
Yeah, voting. Why they are sending you proxy? Because you are the owner of the company, based on what number of the shares you got. So why they send you that? To send you to vote, to find out many things, like if they want to decide about putting somebody on the board of directors, they need your vote. They want to even elect a CEO, they still want your approval. So,
Or acquisitions, right?
acquisition, all these good major decisions, absolutely. Or they want to sell, or they want to spin off, or they want to merge, and all these stuff. So here, he always gets the financial statements of the company, all of them, right? With the greatest detail. They publish it, they give it to you. The same with if you're investing in any company, if you have any account with the either IRA or Root IRA or any investment in, let's say, Fidelity investment bank, they're going to send you your financial statement every month. Hey, this is how, where your money is deposited or invested. This is what was the rate of return on this particular financial asset. This was rate of return on this one. Your bond, treasury bond yield you this. IBM corporate bonds yield you this. Stocks of Apple yield you this, and all these. So those are all available. By law, they are obligated to issue or publish those. So it's always available. Since I mentioned this, also I'm going to make a recommendation for you or suggestion for you. Let's suppose tomorrow you decided to open a portfolio and manage it yourself. Let's suppose. And you're wondering, where I invest my money? Which do I buy bond? What type of bond? Treasury, corporate? Buy bond stocks? What type of stocks? Cyclical, counter-cyclical? Do I buy precious metal? And all these questions, right? And you have no idea. Of course, if you're financial analyst, meaning that you take courses like this and then courses above this, and then you practice this, you become good at it. You know what you're doing. However, at this stage, you may not have really a solid or firm idea as to how you want to buy, what type of financial asset you want to purchase and put in your portfolio. My suggestion is, if you have 401k, take a look at your company's portfolio. Guess who put this portfolio together for your company? A bunch of experts. And then use the guideline. Hey, funds, bonds, stocks, boom, boom, boom. Use that. The people, a lot of experts, spend time putting that together for your company. Take advantage of it. Follow the protocol, if you will. So yeah, that's my suggestion for some of us who like to open an account and create a portfolio, but we really do not have all the tools to come up with the true value of our investments. Do that. This is, oh Jesus Christ, what am I doing? Okay, so no questions on this? What time is supposed to take our break? 7:30ish? What is it? Yeah, I don't remember. Yeah, 7:30ish. You wanna take it now? You ready? No, let's take 15.
Dan, you were gonna go get something from, because I have a different one.
Yes. I'll go around right now.
Was it problem numbers?
Yeah, I'm gonna just tell you what is the difference